Hi everybody and Happy New Year. Well, we want 2023 to be a better year for financial markets than it was 2022. And why it was bad? Well, it was bad mainly because all assets went down together. Usually that's not the case because when stocks go down, bonds tend to go higher. It worked that way for the last 30 years. Last year was not the case because all assets, all investors, and all assets were scared by inflation. So inflation was the big problem of last year, especially how quickly it went higher. So all assets were scared and went down together. So how are we starting 2023? There are two big news. The first one is that Europe is doing better with the energy crisis than we thought. This is especially for the mild weather which we are experiencing, that we couldn't forecast, of course, but we are in January now, so it is probably that we will go through this winter without the disruption that we thought a few weeks ago. This is certainly good for the European economy. Other big news is that China is reopening its economy. You know that they had these big measures against COVID in place, which kept the economy in a sort of lockdown for 3 years. Now they are removing them all, and this is certainly good for the global economy. What about the inflation? Well, we have some signs that inflation is slowing down, both in the US and in Europe. It is at 6.5% year on year now in the US, and it's at 9.2% in Europe. Well, of course, it's very far away from the target, which is 2%, but still, we're seeing some signs of inflation coming down. And in finance, what is important is not only absolute level, but also the direction of changes. So we are far away from the target, but the direction of the moves is a good one. So inflation is contained in a way this year. What is bad is that central banks will continue to hike rates, probably, especially the European Central Bank. They do that because they don't want inflation to go higher more, so they hike rates, and hiking rates, they slow down the economy, and this should help to contain inflation. Of course, given the fact that central banks will keep on hiking rates, next year the focus will be on growth, on economic growth, that could be slowed by the fact that rates are continuing higher. So the focus will be on growth and less on inflation and on interest rates. The fact that inflation is coming down anyway is good for the future, because that was the biggest scare of last year. The situation is better also on the bond side of portfolios that were responsible for a big part of the losses last year. We're starting the year from a better situation because yields are higher, so this gives us a bit of buffer, even if interest rates should go higher more this year. But the fact that we are starting from a higher level gives us a buffer against other losses next year. So for bonds, this was kind of a unique year, which is difficult that will be repeated in the future. So we are not out of the woods. The situation is improving for certain things, especially on the inflation front. But anyway, as we always say, the advice that we give to our client is to invest for the long term. Don't look at volatility and stay diversified. We build well-diversified portfolios. Diversification didn't work this year, but we will go back to normality and diversification will work again. And that is the only way that we have to build portfolios for the long term. Happy New Year to everybody.